Current price, $15.60 USD. Intraday movement, bullish volatility, holding significant premium over NAV. All right, let's sit down and really look at what is happening with Alphatime Acquisition Corp, ticker symbol ATMC, because if you were just glancing at the charts, you were missing the massive tectonic shifts occurring under the surface. Right now, as we speak, ATMC is trading at exactly $15.60. That is 15.60. And if you are watching the intraday action, you are seeing a stock that is defying the typical gravity of the special purpose acquisition company or SPAC market in 2025. Usually, these things sit dormant at $10 and change, or they crater the moment a merger vote gets close. But ATMC? It is sitting at a massive premium. We are talking about a price that is significantly higher than its net asset value. This isn't just a random fluctuation, this is a signal. You probably clicked on this expecting to hear about another run-of-the-mill merger, maybe some vague hype about a company going public and how it's going to change the world. That is the expectation, right? That is the narrative we are fed constantly. You expect to hear that this is the next Tesla stock, or that it's going to perform like Nvidia stock in its prime. But the reality with ATMC is far more technical, far more aggressive, and frankly, far more interesting for a trader who knows where to look. The reality is that this price action at $15.60 isn't necessarily about the fundamental value of the target company, HCYC Group, at least not yet. It is about market mechanics. It is about a potential low-float squeeze that is catching retail and institutional investors off guard. The expectation is invest in the company, but the reality here is trade the structure. Let's back up and create some context, just like we're grabbing a coffee and looking over a portfolio on your phone. When you look at your investment help apps or log into your individual brokerage, whether you use Fidelity Investments, Schwab Intelligent Portfolios, or even the Robinhood app, you see tickers moving green or red. But with ATMC, the movement is telling a specific story about supply and demand. Most SPACs have a trust value of around $10 or $11. If the stock is trading at $15.60, you have to ask yourself, why are people paying a 40 to 50% premium right now? The answer lies in the recent data. On December 4th, just a few days ago, Alphatime Acquisition Corp, an HCYC holding company, announced that their registration statement was declared effective. This is the green light. This is the moment the merger becomes real. Usually, when this happens, you see arbitrageurs sell the stock down to the trust value. But here, the price held and climbed. This suggests that the float, the number of shares actually available for trading, might be incredibly thin. We have seen this before in the SPAC cycle. When investors redeem their shares for cash, which they have the right to do, the remaining shares on the market dwindle. If 90% of the shareholders take their money and run, the remaining 10% of shares become a scarcity. And when you have scarcity combined with even a tiny bit of buying pressure, the price rockets. That is likely what keeps ATMC at this elevated $15.60 level. It is a classic supply shock. Now, let's look at the volume. Today's trading volume is crucial. If you open up your interactive brokers trading platform or check the stats on SoFi Investing, look at the volume relative to the average. If we are seeing spikes in volume on a stock with a low float, that is the recipe for volatility. It means that for every buyer stepping in, the price has to jump higher to find a willing seller. This creates a feedback loop. The higher it goes, the more momentum traders step in, thinking this is the next big squeeze. It draws in the crowd that usually plays Robinhood crypto or chases daily runners. But you have to be careful. This isn't investing in a blue-chip dividend pair. This is high-octane trading. But what are you actually buying if you hold ATMC through the merger? Let's strip away the stock mechanics for a second and look at the business. The target is HCYC Group. They are an insurance broker based in Hong Kong. Now, this is where the expectation versus reality framework gets really spicy. The expectation for a SPAC target in 2025 is often some flashy AI company or an EV startup that promises billions in revenue 5 years from now but has $0 today. HCYC is different. They are a boring, revenue-generating insurance broker. And I mean boring as a compliment here. They have been operating in Hong Kong for over 13 years. They aren't trying to reinvent the wheel. They are selling policies. However, the market's reaction, that $15.60 price tag, suggests that investors might be seeing something else here. Maybe they're betting on a resurgence in the Asian financial sector. We know that the Asian markets have been volatile, but insurance is often seen as a defensive play. People need insurance regardless of whether the economy is booming or busting. HCYC partners with massive names like AXA and Prudential. These are not small players. By merging with ATMC, HCYC is getting a listing on the NASDAQ, which gives them access to U.S. capital and a currency that is stable. For a Hong Kong firm, that access is incredibly valuable. It legitimizes them on the global stage. But let's be real about the risks. We have to talk about the risks because if I just told you buy, I wouldn't be doing my job as your analyst. The risks with Chinese and Hong Kong-based listings have been well documented. There is regulatory risk. There is the risk of the holding company structure. When you buy ATMC, you're not buying the insurance office in Hong Kong directly. You're buying a shell company that has a contract with that office. This structure is common, used by almost every Chinese tech giant from Alibaba down, but it adds a layer of complexity that you don't find when you buy Apple stock or utilize Fidelity Wealth Management for domestic equities. Furthermore, once the ticker changes, once ATMC becomes HCYC, the dynamics change completely. The floor drops out. Right now, SPAC shareholders have a redemption right. They can say no thanks and get their $10 and change back. That creates a safety net. But once the merger closes, that net is gone. If the market decides HCYC is only worth $5, the stock will go to $5. There is no trust account to save you then. This is why the current price of $15.60 is so fascinating. It implies that the market is valuing this deal significantly higher than the cash in the bank. Is that rational, or is it pure speculation? Let's pause for a second. I want to hear from you guys. This is a complex situation with a lot of moving parts. Comment below how many shares of ATMC you currently hold, or if you are staying away from SPACs entirely in 2025. Are you playing the squeeze, or are you investing in the insurance fundamentals? Let me know in the comments. Okay, back to the analysis. Let's talk about the broader ecosystem this stock lives in. We are seeing a shift in how retail investors approach these plays. A few years ago, people would blindly throw money into anything with a ticker. Now, with tools like SoFi Active Investing, Schwab Intelligent Portfolios, and better educational resources on investing sites, people are smarter. They're looking for the discrepancy between price and value. When you look at the chart for ATMC today, look at the support levels. If it drops below $14, does it bounce back instantly? That indicates strong support, likely from the same group orchestrating the squeeze. If it breaks below $12, the momentum might be broken. But as long as it sustains this $15 plus level, it is acting like a cult stock. It reminds me a bit of the early days of certain meme stocks, where the fundamental valuation didn't matter as much as the sheer will of the shareholders to hold. Also, consider the institutional side. Fidelity ETFs and Fidelity mutual funds usually stay away from these high-volatility SPAC plays until after the merger settles. They have strict risk parameters. So, who is buying? It is likely hedge funds specializing in arbitrage and high-frequency traders, along with the retail army on Robinhood cash management accounts and interactive brokers platforms. This mix creates a violent trading environment. You have the smart money trying to scalp pennies and the fast money trying to hit home runs. Let's look deeper into the sector HCYC operates in. The insurance brokerage market in Asia is fragmented. There is a massive opportunity for consolidation. If HCYC uses the capital from this SPAC deal to acquire smaller brokers, they could grow their revenue rapidly. This roll-up strategy is a classic way to generate value. If they can prove to the market that they are an aggregator, a company that buys smaller companies and makes them more efficient, then that $15.60 price might actually be justified in the long run. But that is a big if. It requires execution, it requires a good management team, and it requires the macro environment in Hong Kong to remain stable. Comparing this to the tech sector, when you look at NVIDIA stock, you're paying for future growth based on AI dominance. When you look at Tesla stock, you're paying for the future of